Welcome to this explainer. I'm absolutely thrilled to have you here today because we're going to unpack something that is quite literally vital for your financial future. We're talking about optimizing your long-term wealth against economic volatility. Look, if you're serious about protecting your hard-earned capital from the unpredictable roller coaster of the global economy, you are exactly in the right place. Let's get right into it. So let me kick things off with a quick question for you. What do you think is the absolute biggest risk to your long-term savings? Really think about it for a second. Is it a massive stock market crash? Maybe a terrible real estate deal? Or, just stuffing your cash under a mattress? Well, actually, scratch that. It's none of those things. The single biggest threat is something called inflation risk. It is the silent thief. Basically, it's the risk that steadily rising prices are going to actively rob your savings of their purchasing power over time. You might sit there thinking your money is perfectly safe, totally secure in the bank, but if it's not growing faster than the cost of living, that silent thief is constantly sneaking away with your future wealth. So here is our roadmap for today. First up, the risk of inflation. 2, when traditional assets fail. 3, enter the real assets. 4, timberland as an inflation hedge. And finally, number 5, balancing risk and return. Okay, starting off with section 1, the risk of inflation. What's really fascinating here is that today's macroeconomic climate is almost a mirror image of the period between 2005 and 2007. Right now, the Global Consumer Price Index, or CPI, is sitting right around 3%, and central bank rates are hovering near 5%. But there is a massive difference today. Right now, the money printers are being fueled by enormous government deficits, not just private sector debt like we saw back in the mid-2000s. And because of that, this elevated inflationary environment, it feels incredibly sustainable. It's not just a blip on the radar, guys. This is the environment we have to live and invest in. And why does that matter to us? Well, look at this number, 61%. A major study by the University of Notre Dame Investment Office looked back at the entire 20th century. They found 23 separate 3-year periods where real equity returns in the US were actually negative. Out of those 23 massive instances of wealth destruction, a staggering 61% of them happened during periods of high inflation. So the absolute crucial takeaway here is that high inflation is literally enemy number 1 for your traditional stock returns. Which brings us to section 2, when traditional assets fail. To understand this, we have to look at the fundamental difference between financial assets and real assets. Think about it. Financial assets, your standard stocks and bonds, are ultimately just paper claims on future cash flows. A bond itself doesn't actually do anything. It has no inherent physical utility. Real assets, on the flip side, have direct physical usefulness in a working economy. Because real assets are actual physical inputs that get consumed, they are theoretically way less likely to get crushed by inflation. Now, I know what you might be thinking. Wait, what about TIPS, Treasury Inflation-Protected Securities? They are government bonds literally designed for inflation, right? Well, yes and no. While TIPS do protect your principal if you hold them all the way to maturity, their annual returns bounce around wildly with interest rates. To put that into perspective, between 2001 and 2006, the correlation between TIPS returns and actual inflation was practically zero. Actually, it was negative 0.006. Insane, right? So unless you're holding them to the bitter end, TIPS just don't protect your year-to-year portfolio value from our silent thief. All right, moving on to section 3, enter the real assets. Let's round up the usual suspects of alternative assets. When smart investors want to hedge against inflation, they historically turn to these specific categories, mainly because of their physical nature. We're looking at things like energy, general commodities, precious metals like your gold and silver, farmland, commercial real estate, and our absolute star for today's explainer, timberland. To show you just how powerful these real assets can be, take a look at this fidelity data on metals and mining equities. During periods of high inflation, metals outperform the S&P 500 by an incredible 16%. But get this, during low inflation, they actually underperform by 3%. This brilliantly illustrates how real assets, driven by pure physical scarcity and structural demand, truly shine and flex their pricing power, specifically when inflation is running super hot. That leads us straight into section 4, timberland as an inflation hedge. So what makes timberland so incredibly unique? Well, it's essentially a hybrid. It's both real estate and a commodity rolled into one. And its absolute superpower? biological growth. The trees physically grow larger and therefore more valuable every single day, completely independent of whatever the financial markets are doing. Whether the stock market is crashing or ripping to all-time highs, timberland is just out there, steadily growing physical inputs like dimensional lumber and paper. It's brilliant. Let's look at the hard data here. This scatter plot is basically the acid test for any inflation hedge. We are looking at the 10-year annualized returns of the NCRIF Timberland Index mapped directly against the annual CPI inflation rate for those exact same periods. I want you to trace your eyes right along that orange regression line. Notice how it slopes upward? As inflation goes up on the vertical axis, the nominal returns of timberland go up on the horizontal axis right alongside it. And you know, the correlation here isn't just some lucky coincidence. It is incredibly robust. As our source material highlights, 83.9% of the changes in timberland returns can be directly matched with changes in the inflation rate. That is a massive R-square value. It statistically proves that for investors with a long-term time horizon, let's say 10 years or more, timberland acts as a highly effective, super reliable shield against the erosion of your purchasing power. Let's bring it all home with Section 5, Balancing Risk and Return. The true secret to long-term wealth isn't just putting all your eggs in one basket, right? It's asset allocation. This just means moderating your risk by distributing your capital across different asset classes that react entirely differently to market conditions. By holding different types of investments, especially low correlation alternative assets like timberland, you are actively limiting your overall vulnerability. This curve you're seeing is called the efficient frontier. It charts the absolute maximum expected return you can get for a given level of risk. When you add inflation hedges to a standard stock and bond portfolio, it physically pushes this curve outward. You're essentially expanding your portfolio's efficient frontier. That means you can either achieve way higher returns for the exact same amount of risk or lower your risk while keeping your returns exactly the same. It is a total game changer. Now, before you panic, you don't need to go out and buy a whole literal forest with your life savings. The optimal balance is actually much simpler. Modeling shows that capping your alternative inflation hedges, things like timberland, energy, or real estate, at a maximum of about 15% of your total portfolio is really the sweet spot. A calculated, limited allocation is honestly all it takes to secure the real value of your capital without overexposing yourself. So let's wrap this up with a final thought. I really want to leave you with a question to chew on. Is your long-term portfolio truly protected against the silent thief of inflation? Or are you just holding claims on paper? It might be time to rethink exactly how your assets are allocated. If you want to dive deeper into the world of real assets, there's a whole landscape of opportunity out there just waiting for you. Thanks so much for joining me on this explainer. And as always, stay curious.